Two retirees, same age, same savings, same investments, both withdrawing the same amount every year. But one ends up broke halfway through retirement, while the other still has plenty left after 30 years. How's that possible? The difference isn't luck or even skill. It's something called the sequence of returns risks, and it can have dramatic impact upon your retirement. Stick around because I'll show you exactly what it is, how it works, and most importantly, how you can protect yourself from it. My name is JP Geisbauer. I'm a certified public accountant, a certified financial planner professional, and this channel is dedicated to helping Americans retire smarter and live better. I release videos weekly, so if you enjoy this content, please hit like, subscribe, and you'll be notified when the new videos are released. Let me start with a simple question. Which do you think is more important for your retirement? The average return of your investments or the order in which the returns occur? Most people seem to think as long as their portfolio averages 6 or 7% a year, they should be fine. But during retirement, the average return isn't the whole story. What can really move the needle for retirees is the order of those returns. Poor investments early in your retirement could potentially damage your portfolio permanently, even if the long-term average returns are exactly what you expected. When you're working and contributing to your retirement account, the turbulent times in the equity markets actually help you because you're buying more shares when prices are low. This is what the whole dollar cost averaging concept is about. But the moment you switch from being a net saver to a net spender, the math changes. During retirement, poor returns early on can create financial distress that can be difficult to recover from. Let's go through an example. Each of these investors will start with $1 million. The average return for both investors will be 6%. One will experience an up market in the early years, while the other will experience a down market. Each investor will take out $60,000 a year for living expenses. We're going to look at a 15-year time horizon. For the purpose of this example, we're ignoring income taxes and isolating just the investment returns and withdrawals. So here's the chart. As you can see, the blue line shows that there is plenty of assets available at 15 years. However, the red line illustrates that the down years in the beginning had a serious impact on the portfolio value and may threaten the person's retirement. But again, both of these lines show a 6% average return over the duration. Now you're probably thinking to yourself, well, this is terrifying. But don't worry, there are strategies you can implement to help you reduce the effect of the sequence of returns risk. Number one, use a bucket strategy. Think of it like this. You've got 3 buckets of money. One for the short term, another for the medium term, and the final for the long term. The short term one should be invested in cash or very safe bonds to cover a predetermined number of years worth of expenses. The medium term should generally include bonds and maybe dividends paying stocks. The long term should include growth investments like equities. Why structure your investments like this? When the markets are down, you pull money from the safe short-term bucket instead of selling your stocks at a loss. When markets recover, you refill the short-term bucket and prepare yourself for the next market disruption. I did an entire video on the bucket strategy. If you'd like to learn more about it, click on the link in the description below. Number 2, dynamic withdrawals and guardrails. Instead of sticking to a rigid withdrawal strategy like the 4% rule or the $60,000 per year in our earlier example, embrace flexibility. If markets are down, maybe tighten your belt and spend a little less during those years. If markets are strong, give yourself a little raise or be a little more indulgent. Think of these concepts as guardrails. They keep you from launching yourself off a cliff on the hairpin turns, but still give you enough room to decide which lane you want to be in. Number 3, delay Social Security. By delaying Social Security, you lock in higher guaranteed income for life. That income acts like a buffer, reducing how much you need to pull from your portfolio during downturns. However, be sure to adjust your short-term bucket accordingly during the years you're waiting to claim. Not having any Social Security income coming in and a portfolio that's too aggressive could be a recipe for disaster. You could be forced to sell more of your equities than you'd like. At the end of the day, make sure your investment asset allocation takes into effect your Social Security claiming strategy. Number 4, draw from Roth accounts. If all of your money is in a pre-tax accounts, you don't have a lot of flexibility. When the markets are down, you'll have to take distributions not only to fund your lifestyle, but an additional amount to cover the related income taxes. However, if you build tax diversification by having balances in taxable, pre-tax, and Roth accounts, you can choose where withdrawals come from depending on the market performance. Having a down year? Maybe pull more cash from the Roth. Strong year? Maybe take a little more out of the pre-tax accounts. Having this kind of flexibility creates amazing opportunity. Number 5, stay invested and don't panic. Markets have always recovered. Every downturn in history has eventually been followed by a market that reached new heights. If you sell your equities into market chaos, you lock in your losses and aggravate the sequence of returns risk. Stay calm and have a plan. Now, I know that was a lot of information. You don't have to choose just one strategy. The most bulletproof retirement plans combine several of these approaches. Which of these strategies do you think you'd be most comfortable using in your retirement plan? Drop it in the comments below. I'd love to hear your thoughts. If you'd like to discuss your drawdown strategy as it relates to your comprehensive plan, use the first link in the description below to schedule a time with me. As I indicated earlier, I did another video on the bucket strategy. This is a critical strategy to help you mitigate the sequence of returns risk. You can find a link to that video here. If you enjoyed this content, please hit like and subscribe. Thanks for watching, and I'll see you next time.